We saw some numbers on Friday that indicate the economy overall looks pretty strong, at least when it comes to jobs. How are the markets reacting to all this information?
It was a strange employment report, right? So it didn't coincide with necessarily some of the other data that we're looking at, such as NFIB, hiring intentions, the home-based data. They would have told you that the labor market would have been a lot weaker than the number that we had printed today. But the good news is, and that what the equity market held on to, is the gentle decline in average hourly earnings. And that is good news on the inflation side, because you've had very sticky inflation. It's been coming down, but coming down probably slower than what people expected. But to see the easing in the wage data is a very good positive development.
So, Erin, it raises necessarily the question, what is the Fed going to do? Does the Fed say, boy, that's an awful lot of jobs, therefore we're going to have to raise again? Or can they pause or skip or whatever they're calling it these days, the way they've been telegraphing?
It certainly throws a wrench, certainly into how the Fed's thinking about the evolution of the economy. And, just earlier this week, there were comments on the tape from various Fed governors, Powell included, that were hinting at a potential pause at the upcoming FOMC meeting. And certainly the timing of this release is inconvenient. That said, I wouldn't get too hung up on whether or not the Fed hikes one additional time or not. Most likely they will pause at this upcoming meeting, but do a hawkish pause, meaning, they'll talk about the potential for further rate hikes down the line if the data doesn't evolve the way that they're hoping it will. But I think what is important to keep in mind, at least from an investor perspective, is whether or not they hike one additional time or not, it really doesn't matter in the grand scheme of things. The lagged effects of monetary policy is really what's going to matter. The significant amount of tightening that happened last year still needs to work its way through the system and still will continue to tighten financial conditions for the market and for the economy overall. And that's the bigger picture of what's going on right now and what's ultimately going to, potentially affect the economy and lead to a further slowdown from here.
Barbara, we've heard an awful lot about this lag in the effects from monetary policy. How long a lag should we expect? Because, boy, it doesn't seem to be showing up very profoundly so far.
So it tends to be about, when the Federal Reserve started hiking interest rates, it was about 14 months ago. There tends to be a lag of about 24 months between when the Fed starts hiking and when you start to see a dramatic slowdown in inflation. That means we should have at least the rest of this year into the first quarter of 24 before you start to see a significant slowdown in inflation. Look, when you look at things like the sticky price CPI or the underlying inflation gauge, they were at, between 6 and 7% just 6 months ago. They're down now to about 3.5 to 4.5%. Well above the Fed's target, but they're going in the right direction. In order to get down to the 2% on inflation, which is the Fed's target, you likely need to see a little bit more time go by. Think about this, David. The real issue is that the Fed hikes, the 75 basis points that they did over the course of 3 or 4 meetings last year, they happened in the third and fourth quarters of last year. You need at least 12 months for that to start to be felt by the economy and start to see the slowdown. You're seeing it in some of the data change indexes. You're starting to see some slowing. Certainly not indicative of the labor market this morning on that report, but I would say that data can change and can change relatively quickly. So I would think that you've got more slowing coming ahead of you, even if the Fed did nothing going forward.
Erin, when you talk about data changing quickly, I'm going to make a shift here over to AI and tech. Well, we've seen a big change quickly in that. How much of this is a tale of two very different equity markets, one of which is a relatively narrow tech, big tech, driven by AI, and the rest of the market going a different direction?
I think you're exactly right. I mean, the market breadth or the leadership has been incredibly narrow for the S&P 500 this year. In fact, if you look at just the equal weighted S&P 500, it's actually down on the year, yet tech has had a stellar performance. A lot of that is off of very weak performance last year, but certainly AI and automation has gotten the markets excited about future growth prospects for the tech sector. And this is another avenue of growth. Keep in mind, even for NVIDIA, which is one of the leading, semiconductor manufacturers and designers rather, and certainly has a leadership role with respect to AI, it's an incredibly small percentage of current sales. And so really what you're betting on within the tech sector right now is future growth. This is secular growth for the tech sector, not something that's really going to turn up materially in earnings over the next several quarters. And so I think that the market has gotten excited about this theme, but it's probably a little bit ahead of itself in terms of price action, just given the fact it's not going to materialize in earnings anytime soon. That said, I think that the market this year came in looking for, opportunities to buy, to bottom pick underperformers last year. And you've seen it with the tech sector, you've seen it with the retailers, you've seen it, sort of, across the board. But these are really more idiosyncratic rather than, the market breadth overall, which has been narrow. And so that to me is telling me that, potentially the market's getting a little bit tired. And potentially we may be in for tougher days ahead as leadership, starts to narrow. That tends to not be, the greatest investor for the greatest environment rather for the average investor.